All right, we are going to issue stock in this video. Okay, so we need to talk about par value before we can really go any further. There are two situations when it comes, we'll just start with common stock for a moment. So we have common stock, and then we have common stock par value. And then common stock is also going to have a market value. Okay. The market value and the par value are two different things. Par value, okay, I have no idea what it is. All right. It's an arbitrary number. It's set by the legal department and it's artificially low. Okay. So not every, a lot of common stock will have a par value. Okay. And now let's talk about how we would account for stocks with par value. So let's take it one step at a time. Let's just look at this particular example. On June 5th, Dylan Snowboards issued 30,000 shares, okay, of $10 par value stock for 300,000. So we're saying that, they make these fucking things so complicated, but we're saying that we're going to issue 30,000 shares, okay? And we are going to sell them for $10 a piece. It has to be the case that 30,000 times $10 per share is 300,000. So in this example, the par value equals the market value. All right. So all we're going to do if we issue at par is we're going to debit cash for the 300, right? Cash is an asset. And if I want to increase an asset, I do it on the left side of the T account. And then I'm going to credit common stock 300,000. And I will call it common stock with a $10 par value. All right? That is issuing at par. That is issuing common stock for a price that is equal to the par value. But that mostly never happens. We usually happen to sell common stock with a par value for more than par value. We can never sell it for less than par value. Okay, so new example. On June 5th, we are going to issue 30,000 shares of this $10 par value. However, we're going to sell the stock for $12 per share. Okay? So I'm going to do it in a three-step process. The first thing I'm always going to do cash. And the cash is always going to be the number of shares times the market value, right? The price that we are selling them at. And so I'm selling 30,000 shares and the market value, okay, is $12. That's what we're selling it for. So 30 times 12 is 360,000. Okay. That is step one. Now I am going to put the amount in the par bucket. So the first category is going to be the common stock at par. And I'm going to put the number of shares, 30,000, times the par value of $10. So 300,000. Okay? That's going to go in the common stock par value. It'll be equal to the number of shares we issued times the par value. And then anything left over, the difference between 360,000 and 300,000 is what we refer to as paid in capital in excess of par, right? And so 360 minus 300 is 60,000, right? These two categories right here, those are both equity accounts, right? So if I think about assets equal liabilities plus equity, we were saying equity has two buckets, retained earnings and capital. Man, this is a throwback to like the first weeks of the semester. Okay. Capital are these two accounts. So it's common stock at par plus the additional amounts that were paid into capital. All right. And then retained earnings is the second category. So I have this portion right here, which is capital, and that is retained earnings for total stockholders' equity of 425. That's what it would look like after we issue stock for more than par. Okay. I have common stock that we could issue. It's a different type of common stock and it has no par value. Okay. And so since it has no par value, right, we would just have one bucket that it goes into, and it would be the common stock that has no par value. This particular example, we're going to issue 1,000 shares. There's no par value, and we're going to sell each one of those shares for $40 a piece. And therefore, we're going to generate 40,000 in cash, $40 per share times 1,000 shares, 40,000. And then, like we said, it goes into just that one bucket, common stock, no par. And maybe if we're lucky, it'll show us no, okay, we're going to do a different example. So we now have common stock with par. We have common stock with no par. And now we have common stock with a stated value. And a stated value is, again, an arbitrary number. It's not a par value, it's a stated value. And what the difference is between par and stated, you're asking the wrong person. I've gone 35 years now since I've taken this class, and I've never had to worry about the difference between stated and par. Okay? So let's just look at what's happening. In this particular example, we're going to sell 1,000 shares, and the stated value is $40. And then the market price, the price that we're selling it at, is 50. So again, step one, I'm going to put cash equal to the number of shares times the market value. And so 1,000 shares times $50 per share, $50,000. Step two is it's not the par value, but it's the stated value. And so I will put the 1,000 shares times $40 per share. So I would credit common stock, stated value. That's step two. And then finally, step three is everything in excess of stated value. So I issued for 50, my stated value is 40. So excess of stated value is the 10,000. Just like we issued for cash, we could issue for something other than cash, right? So I can contribute land to a business in exchange receive stock. So in this particular example, I am contributing $105,000 worth of land, and so I would debit, or we would debit land, 105,000. And again, we're receiving in exchange 4,000 shares, and every share has a $20 par value. And so step two, right? Step two is 4,000 shares times 20,000. I'm coming up with $80,000. And then the value of the land was 105. The par value was 80. And therefore everything in excess of par value, step three, goes into that other bucket of equity. And I guess we could exchange organizational expenses. So somebody could provide services to us, and in exchange, we can give them stock. Like they can contribute sweat equity. That's what this is, right? And so the value of the equity, the sweat equity that they gave us, is 12,000. That's an expense to the business. And then we issued 600 shares. with the $15 par value, 600 times 15 is 9,000. And the difference between the market value of what we received relative to the par value of what we gave is going to be 3,000 in this example. And again, it goes to paid in capital in excess of par value.